On behalf of the PAN IIMA Alumni Association, I'd just like to welcome you for the webinar this evening. Thank you for taking out time and joining. Today's topic hardly needs an introduction. We're living through a pandemic and it's upended every aspect of life as we know it. The lockdowns to contain the virus have brought economic activity to a complete standstill. And yet, an outsider looking at our markets may not be able to guess the extent of the crisis. So how do we make sense of all this? How do we position our portfolios for now, the immediate run, as well as for times beyond? To discuss this and a lot more and to take your questions, I'd like to invite Mandeep Nalva, PGP 94, CEO of Taurus Wealth Advisors, to introduce our panel and also moderate the session. But before I hand over to Mandeep, I'd also like to quickly say a line of thanks to the PAN IIM Association for allowing us to use their Zoom infrastructure. Thank you, guys. And we, of course, have members from the other IIMs also joining this webinar today. So thank you as well. Welcome. Mandeep.
Thanks, Deepika. Ladies and gentlemen, thank you very much for the time you've taken out on a Saturday to try and figure out the million-dollar question. Why the hell is this market going up? And what should we do? But more on that later. First, our panel for today. It is a privilege to introduce Harun Shah, Chief Investment Officer of Taurus Wealth Advisors. Harun is a 32-year veteran of the markets with lots of gray hair to prove it. Interestingly, he started his career a month before the 1987 crash. He has worked with various institutions, most notably Citi Private Bank, for 15 years before joining Taurus. Along with Harun, from Taurus, we have Nirman Chabra, a fixed income expert and also an ex-Citi banker. Nirman manages the Global Diversified Fixed Income Fund, which has achieved a 98th percentile rank in its asset class performance in 2020, an outstanding result given the times. Our third panelist is markets expert Mansoor Khan, who heads up research and operations at the GNP G2 Fund, a global macro fund. Mansoor has long experience in financial markets and trading, stretching back 30 years. But the culmination of that experience is extremely well exemplified with the following. Year-to-date 2020 return of the G2 fund is plus 9.9%, up an excellent 5.78% in March, and another plus 2.65% in April. He and his team somehow made money when the markets were selling off, and they made money when the world was recovering some of the losses. Market crashes teach you a lot more than any MBA class or benign markets can. Our speakers have seen their fair share. As the moderator, my job is only to ask a few questions and convey your questions, which is about right, as my experience in markets cannot compare to our esteemed panel. For the record, as Deepika mentioned, I'm a class of 1994, I'm Ahmedabad, and I run Taurus Wealth Advisors, a multifamily office here in Singapore and in Dubai, and we advise on about $2 billion of client assets. The structure of the discussion today is a little different. We have Harun and Nirman, who will first give a presentation on the markets. They will share their slides. Thereafter, Mansoor will share his take on the global economy, and then we will move into questions and answers. Please keep your questions coming up by typing through the icon at the bottom of your screens or at the top of your screen. It's either or. We will ask as many as we can at the end of the combined discussions. All yours, Harun.
Thank you, Mandeep. Good evening, ladies and gentlemen. Thank you very much for joining us here on this webinar. I think we all are living through extraordinary times. I think it's very interesting what's going on. I think none of us have ever experienced it. So today I'm going to start off with, just kind of revisiting where we are in the scheme of things. And so I would say that, the global economy has gone through an unprecedented lockdown. I think about half, or if not more, of the global economy was shut down for a period of time. And I think right now we are going through, what they call it, reopening, but the damage has been done. Most economies have contracted sharply, and the expectations for recovery are relatively expected to be slow. Governments, central banks have done a lot. Basically, we have seen huge stimulus budgets coming out from the likes of the US and most governments around the world. But is it enough? Only time will tell. I think the US having done $2.5 trillion so far, I would say is amazing. But they do realize that the economy came to a complete standstill and they needed to do something urgently. Even central banks around the world have cut interest rates as low as one would expect, but also have done a lot of quantitative easing, especially the Fed, which is the kind of the central bank of the world. This definitely has resulted in, as I said earlier, a lot of disruptions. And I think the most obvious place we see it is people losing their jobs. The US alone, you have seen over 30 million jobs being lost in the last few months. That is a record by itself. The last time it even comes close to this was back in the 1930s during the Great Depression. So that is why we hear people saying that we might be seeing a deep recession or maybe even a depression evolving from this. Financial markets, well, they have been really, all over the place. We have seen huge moves. Commodities, I think most of us were kind of scratching our heads when oil went to minus 35 last month. Of course, it's crawled back since then, but, it just showed the kind of dislocation that was occurring in the markets. Credit markets also were totally dislocated. We saw in certain instances where there was complete lack of liquidity. But, financial markets have been volatile. And as Mandeep alluded earlier, we have seen a huge recovery, and I think a lot of people are scratching their heads and wondering why. Hopefully, we'll be able to give some background to that during the course of this webinar. Now, when you look at markets, just a quick snapshot. This is as of yesterday. If you notice, it doesn't look as bad as people might say. Oh, the markets fell, but the recovery has been quite sharp. In the case of, you look at the US, S&P is only down about, close to just under 8%. And the NASDAQ has done phenomenally well. It's actually recovered all its losses and is up. And most of the other major markets are relatively, they're down. But, when you look at a chart like this, it seems like a normal correction kind of situation. But I think the real, I would say the real stress was back in March 23rd, when most of the markets just basically fell off. And if you look at this chart, I think it gives you a better and clearer picture to the depth of the crisis that we went through. If it wasn't for the Fed fast reaction and jumping in to basically help the credit markets, I think the picture would have been a lot different. But you can just see that there was a lot of stress in the financial markets. But why was this the case? I think that the real story there was, as I mentioned earlier, we have never been through something like this before. And when you look at the US economy, it basically contracted about 4.8% in the first quarter. And I can bet the second quarter is going to look equally bad. The last time we saw something like this was back in the great financial crisis. And if you look at Europe, which is the other epicenter, I mean, it's the same picture. Across Europe this year, growth is expected to show sharp falls and unemployment sharp increases. These are very, very large numbers. Now, to say that, just because the economies are opening up, are things going to look better? I'm not too sure. It will definitely take a lot more time before we get these numbers back to more normalized levels. And as I said earlier, you look at what central banks did and what governments did. It is quite amazing. I mean, the amount of stimulus, which is right now running at about $8 trillion, is a big sum to speak of. If you look at percentage of GDP by most regions and countries, it is quite substantial. Now, this is not over. I think we're going to see more stimulus coming out from governments, but also the central banks. They have loosened their monetary policy as much as they can. I think the one that's been the most aggressive has been the US, where basically their balance sheet, which was about 4 trillion at the start of this pandemic, has in a matter of weeks gone to 6. And the latest number I have now is that it's reaching 7 trillion. People are saying that that number can go a lot higher. Now, that is an amazing number just by itself. It's much higher than where they went during the great financial crisis. But I think what is worrying people more is that will we see a sharp rebound after the economies open up? I mean, the nearest case study would be China, because they went into this crisis first. They're the first one that came out of it. They came out in late March, early April. And you can see, yes, the initial reaction as the economy opened up, everything bounced back: industrial production, retail sales, investment. But it hasn't recovered to the levels it was before they went into this pandemic crisis. And if you listen to all the evidence that's coming out, I mean, retail sales are showing very muted increase from the depressed levels. You're seeing industrial production slowly getting itself back on the feet. There are many companies that have not even opened or are basically returning because the businesses just can't basically weather the storm that went through. They basically have gone past. So we are going to see the same picture most likely in most of the other economies. We are going to see that the recovery from this crisis is going to be slow and painful, and it will take time for the wounds to basically heal. So that is one of the worries that we will have going forward. But then the question comes out, why are the markets rallying as much as they are? Because when you look at the S&P 500 earnings, I mean, this is earnings expectations for the various quarters. Of course, the deepest one is going to be this quarter. In the second, expectation is that earnings will decline by over 31%. But as we all know, equity markets are a discounting mechanism. People are looking forward. So if you look at the third and fourth quarter and the earnings drop is going to be less and less, the markets are discounting a V-shaped recovery in the global economy, especially in the US. Whether it happens or not, I think the jury is still out. But my take is that if China is a good indication, I think the process might be a lot slower. But why did the market rebound so strongly? I think what would give us a better indication, because valuations definitely don't look cheap. If you look at the S&P 500, it's a lot higher in terms of PE than they were before, simply because earnings have come down very sharply. But I would say that why that is happening is this slide gives you a good indication. The 5 big stocks, basically, the FANGs, basically are the ones that have driven this market a lot higher. As a percentage of the S&P 500 right now, they are running at about over 20%. And if you look at their performance as at the end of April, they were up 10 when the rest of the S&P 500, 495 of them, were actually negative 13%. So it just shows that, just these 5 stocks are driving the indices higher. But the broad market, even though they have recovered somewhat from the lows, are not the primary vehicle. So it's not a very broad market. It is quite narrow in terms of its breadth. Now, this is why a lot of people are kind of concerned, saying that the markets have recovered, but they have recovered on a very narrow base, and maybe due to the weight of liquidity that the Fed has kind of pumped in. This is something that one needs to keep in mind, because you can't continue having few stocks driving the markets higher. Then when you look at emerging markets closer to home, I mean, the amount of money that has kind of gone out of these markets has been huge. Fear and the fact that all that excess leverage in the system kind of reversed itself, and this was the second largest and fastest outflow of funds going out of emerging markets. The biggest was the global financial crisis, but that happened over a period of time. This one has happened in a very short period. So that is why I think if you look at Asian markets, yes, they have rebounded, but they have not rebounded as rapidly as what we have seen in the US. But I think the key question now is, all of that is in the past. What do we see going forward? I think to really understand markets and how we kind of position ourselves going forward, we need to understand the conditions in which we will have to basically work with. I feel that there's going to be 4 major themes that are going to be the key factors that one needs to keep an eye on. Growth definitely is going to be slower in the coming years because of the number of reasons. One is that the businesses will have to repair themselves. Consumers will have to feel confident enough to spend money. But also it's because, debt levels right now, both at the government level, corporate level, and even individuals, consumer level, is at record highs. And as such, we are going to see people ability to spend more going to be relatively muted. Of course, the other big thing that is going through the global markets right now, and I think we saw it with the trade war, is that this concept of deglobalization. And I think this is something that is worrying everybody, because the crisis kind of highlighted the supply chain issues, that a lot of stuff is built in countries like China. And when things get dislocated, the whole supply chain gets disrupted, especially for key components. So, medical equipment, I mean, that's why you hear so much from the Americans that we got to bring it back home. And this deglobalization theme is going to play a big part how we achieve growth going forward. So they're kind of all interrelated. And finally, of course, the last thing is inflation. I know this is a bit controversial, because the last 10 years, everybody has been saying, where's the inflation, even though we have been pumping lots of liquidity and keeping interest rates low. now that they have pumped more liquidity and kept interest rate to even lower levels, are we going to see more inflation? I think the jury is still out, but I think there are a number of reasons why inflation, as the way we measure it, has not shown up. Now, when we look at each of this, now the reason why I think growth is going to be slower, now this just basically looks at the major economies in the world, comparing them now versus what happened back in the global financial crisis. I think the key would be the one on the right to show that back in 2009, even though the major developed countries were in pain in terms of growth, the bigger emerging markets were somehow able to keep growth up. China did a huge stimulus budget, and they kept their economy growing at a rapid pace and basically keep the engines of growth going. This time, China, along with the rest of the developed markets, all are slowing down at the same time. So we are basically seeing a very synchronized markets, and as such, I think growth going forward will, as such, take a lot more harder to kind of pick up steam as we get out of this. Similarly, when you look at debt, as I was saying earlier, we are right now at record debts. And if you look at the amount of debt that the US, Europe, even China, which announced a new stimulus budget, Japan, the big ones, are all creating. The amount of debt that's piling up around the world is huge. If you look at the US, its debt to GDP has gone above 100. China, even though the number looks low, that does not take into account all the debt that is at the provincial levels. Japan has been at a huge 200 and 240 nearly percent of GDP. See, all these countries are reaching the upper limit, and the more they spend doesn't mean you get growth. You're just basically keeping the wheels going. So growth is not going to be helped by taking on more debt. Similarly, I think, as I mentioned earlier, deglobalization trend will hamper growth. And I think that is going to happen. This chart basically just shows you that, intermediate goods, which is basically components that go into other products, many countries have a disproportionate amount that comes from China, or basically. So if you look at, example, the US, you have a very high number, somewhere around 30% of components come from companies that are situated elsewhere for cost reasons. Now, when they get disrupted, what happens? Your whole supply chain kind of goes upside down. So that is what has been going on, and that is why a lot of countries are now talking about bringing production home closer to where they are. So if that happens, then you're going to see that it's not about efficiency, it's all going to be about making sure that you basically have control over the goods that you are producing. And finally, as I mentioned, inflation. This is something that is kind of baffling a lot of people. If you look at the stock of M2 money supply, that has been growing quite rapidly, continues to grow. But at the same time, the velocity of money, the rate at which money moves, has been kind of coming off. Now, this could be a number of reasons. People are using that money to either pay off debt. It could be due to demographics, as older people tend to spend less. It could be a multitude of reasons. But this is why we are not seeing, even though the stock of money going up, inflationary forces picking up rapidly. But that could change going forward because we are spending unprecedented amounts of money. So I think in conclusion, I think we are moving into a world, what I call the new normal. It is definitely something that all of us are experiencing. The way we live, the way we work, the way we shop, everything is changing simply because we are not able to go back to that normal behavior. That is going to basically also affect recovery. But this reopening that we are seeing is a very tentative one. We all are worried that unless we get a vaccine put in place, people are still concerned that there might be a resurgence in infections, and then again we go into a lockdown. Central banks and fiscal policy, I think they're going to remain very, very accommodative, and I think that's something that's going to remain there for a while. And this is why I worry about the amount of liquidity that's sloshing out there. And I think there's also going to be some longer term ramifications. I think this tension right now we are seeing between China and the US, I think is a function of that. Political risk will increase as growth slows down. Government policies also will reflect this new environment. So we are going to see a lot more tension in the global economy. And I think that is something that we will have to keep a very close eye on. But I think the key as we go forward will be the fact that we will need to manage risk in this environment. Yes, people will see markets rally as we've seen in the S&P 500, but does it make sense I think that is the key here. Now, you can make money if you're a trader, but if you're a long-term investor, you can definitely get whipsawed in markets such as this. On an asset allocation basis, I mean, this is some ideas I have, basically looking at a balanced portfolio. I would say in the fixed income market, our preference is for quality, remain in the good side of the bond markets, hold investment grade bonds. I think that's something that, even though the yields are low, but I think it's better to be safe than sorry. I think in the high yield space, we have kind of gotten a bit more comfortable with US high yield, simply because we do see, the fact that the Fed is coming in to support this part of the market, that gives us some comfort that they will not allow too many defaults to happen. I think in equities, I think are still relatively cautious. We are underweight, but we are selectively exposed to China, Europe, and the US. But when I say, selectively, I think it is important to distinguish good companies. There will be the new economy companies that will do well. That is why I think we have seen the FANGs doing very well. But also at the same time, companies with great brands, companies with great balance sheets, they will survive this, and actually they will come out of this much stronger. So those are companies, if you get an opportunity, will be a great buy. The other area where most people are not very, it's not a well-known area, is alternatives. These are basically strategies, fund managers who employ strategies which are market neutral, non-directional. And I think this, in a market such as this, where we expect volatility and, the longer-term trends to shift, I think they have the ability to generate sufficient alpha in markets such as this, so because they are the experts in this region. So I think those kind of funds have a place in portfolios. And finally, of course, gold. We do feel that gold will be something that will benefit from the fact that if central banks keep interest rates low and governments are spending a substantial amount of money, then, at some point, either inflation will show up or that liquidity will have to go into places where people feel there will be a store value. So all in all, as I said earlier, these are some of the ideas that we feel works at this current moment. But of course, where we put money shifts as markets, move along. So, if you ask me 6 months from now, is this the asset allocation? It might be slightly different, depending on what happens in the global economy and what happens in the financial markets. Now, let me just stop here. At this point, let me just kind of move and let my colleague Nirman to talk about the fixed income outlook.
Thank you, Haren. Good evening, ladies and gentlemen. I'll cover the fixed income outlook. Like Haren has mentioned, it was really the US Federal Reserve which really acted decisively and very aggressively in the month of March, when all hell was breaking loose in the markets. And as this chart is showing that, from the last so many years, their balance sheet was accumulated to 4 trillion. And in just about a couple of months, they've added 3 trillion more. So 75% increase in a matter of a couple of months. And that is really unprecedented, and really their commitment to buy US treasuries, mortgage-backed securities, corporate bonds even for the first time, and other loan-backed securities, etc., has really pumped liquidity into the system, which was really tight on liquidity. This chart is basically showing one measure of liquidity, that is basically the forward rate agreement for 3 months minus the overnight index swap rate. So the higher this number means, the higher is the spread for 3-month lending to overnight lending, means that the market is tight on liquidity. As you can see, in March of 2020, this had spiked sharply higher, and it was really the Fed's actions that since then this liquidity measure has calmed down, and it was not allowed to go back to the 2008 levels, as you can see on the extreme left side of the chart. The Fed fund rate has also been cut to zero. It's very close to the zero bound. There is some chatter that it can even go negative, although the US Federal Reserve Chairman has clearly said that that is not a policy tool that they will pursue. They will use some other tools in the toolkit, and they will continue to use quantitative easing, that is buying assets like treasuries, mortgage-backed securities, and even corporate bonds to support the liquidity in the markets. The 10-year treasury yield, which is a somewhat of a barometer of the economic cycle, has been on a downward trajectory since really Q4 of 2018, when the economic weakness had really started. It's somewhat hidden by the tech sector, which has been booming, but the rest of the economy has been weak, and the 10-year treasury yield has been falling. In the beginning of 2020, it was about to turn and it touched about 2%, but since the COVID crisis has hit, we have just accelerated into a recession, and now we are at 0.65% approximately. And the Fed has really said and made their commitment quite clear that they would like to keep the long-term rates low, and we would think that the long-term 10-year treasury yield would remain capped at around 1%. The shape of the yield curve, which is the 10-year treasury yield minus the 2-year, which is the shorter end, is somewhat also an indicator of the economic cycle. Towards the later parts of the economic cycle, the yield curve flattens and even inverts, which we saw in late 2006, early 2007 in the previous cycle, and in August of 2019 last year. Similarly, after the recession starts, the Fed cuts the shorter end, and this yield curve starts to steepen again, and we are seeing that phenomena play out to some extent, as the 2-year obviously has almost touched the zero bound, whereas the 10-year also has rallied, but hasn't rallied as much, causing a bull steepening of the curve. From here on, I think we would want to see a little bit more steepening of the curve, because that would give more incentives for the banking sector and other non-banking lenders to incentive to lend for longer maturities, and that could be the next leg of the credit expansion and the economic recovery. Inflation expectations, I think Harren had mentioned about this earlier. This is just one of the measures of inflation expectations, which is the 5-year break-even rate as derived from the Treasury inflation protected securities. And again, similar to the 10-year Treasury yield, has been on a declining trend since Q4 of 18, and still is in a negative trend, but also has bounced from the lows. But it still is below the Fed's 2% target at around 0.8% per annum. Lastly, I think the manufacturing PMIs and the other broader PMI indicators continue to be weak. We have seen an unprecedented drop in Purchasing Managers Index, which is a leading indicator for the economic activity. And all these measures have till April were falling at a faster rate. So it was clearly in a downward trajectory. In the last readings that have come last week, they are still contracting, but at a slower pace. So there is some silver linings that are emerging as the world restarts after the COVID shutdown. And then there is a bit of a bifurcation here, that the manufacturing sector PMIs are definitely higher than the services sector, which also is consistent with the fact that the manufacturing activity has been started to a large extent with the COVID sort of prevention measures in place at the factories, whereas the services sector PMIs haven't really recovered. Obviously, many of the businesses remain shut. Hotel industry, the airline industry, and other similar service oriented like theme parks, etc. They also, I think, are not operational yet. So, and the services is the bigger part of the US economy, for example, and certain other economies like India. So it will be interesting to see how we are able to come back into services from this COVID shutdown. So moving on to the credit markets, from the macro, this is just a very long-term movement in credit ratings at the sovereign level. The Asian sovereigns, which had really emerged from the Asian financial crisis, battered, and their ratings were low investment grade or even high yield, have since in the last long 20 years have grown their GDP rates are the fastest in the world, and debt levels obviously have gone up, but haven't gone up in the same way. So overall, the sovereign ratings have been on an upward trajectory in most of Asia. The opposite is true in actually developed markets that are plagued by high levels of debt at the sovereign level and low GDP growth rates. These charts are basically trying to measure corporate credit sort of trajectory in developed markets. The orange line are basically for the US Russell 2000, and that is a mid-cap and small-cap index, which is more a representative of the broader US economy. And the purple line is for MSCI Europe. As you can see, the US has been leveraging up. As you can see, both the measures, that is net debt to EBITDA and the total debt to assets, have been going up, whereas European corporates have been deleveraging. Obviously, they were hurt by the sovereign crisis of Greece at the beginning of the last decade. So there have been diverging trends, and I think it's consistent with the fact that the credit quality in the economy was not very good. The debt levels were high in the US. A similar bifurcation is seen in in MSCI Asia Pacific and MSCI LATAM. Asia Pacific is in orange and Latin America is in purple. Asia Pacific, I think, fell towards the middle of the decade and then has been re-leveraging up, although the debt levels are not extremely high, but they have been re-leveraging up. Latin America has been following a little bit of the commodity cycle as the commodities boomed towards the mid of last decade, and then we have seen really a long cycle of decline in the commodity prices. The debt levels have also come down. That is a good sign.
Irman, I'll jump in here for time. I think let's move to Mansoor, because there are lots of questions that have come up, and I'm sure the audience would like the answers to them.
Okay, maybe I'll just cover the outlook in just a couple of minutes, and then I'll move to Mansoor. Just one moment. Well, anyway, I think it's. Yeah, thank you. Very quickly, I think I'll just take another minute in terms of the outlook. We definitely like the investment grade part of the credit market, although one has to be careful when investing in the low investment grade, BBB minus category, because there is this fallen angel risk that some of these corporates or sovereigns could get downgraded to high yield. So one has to be very choosy when investing in the lowest part. In high yield, certain sectors definitely will remain challenged, like oil and gas, retail, hospitality, airlines, and commercial real estate. But then there may be some opportunities for distressed investors in those sectors. But companies that are infrastructure type industries have relatively less debt and low near-term maturities and are national champions. There could be more opportunities on the high yield side there. In general, I think emerging market high yield will remain challenged till we see a sustained sort of recovery in the commodities. But a case can be made that the valuations are attractive enough to take a dip, but only very selectively. Among the bank capital, we have an underweight rating there as well, because we could see negative surprises as far as the NPL rate ratio trajectory is concerned for the major banks in the world. So with that, thanks very much. I would like to pass it over to Mr. Mansoor Khan from GNP Asset Management. Thank you.
Thanks, Irman. Good evening, ladies and gentlemen. I thought I'd take a few minutes to describe how the fund has been navigating the excitement over the past few months. We've all heard this story before. Look at the market moves this year. Of course, a trend follower should make money. Some have made money in 2020, some have not. Most of the people have done better than the market. Still, many have underperformed relative to expectations, given the circulating theme about crisis alpha. The key to understanding who will make money is to go back to basics. Are there trends? Did managers have a way of exploiting or identifying these trends? Did managers have high exposures to those markets that showed trends? We have a simple framework of styles, markets, trading styles, timing, and markets to classify trend followings. The questions we get asked repeatedly: what is your style for finding signals? What is your timing or look back period? What markets and exposures do you trade? However, this is all based on whether there are trends to exploit. Let's focus on the simple idea that trend followers make money when there are trends. If no trends, then no profits. Trend following performance can be broken into three parts as we look at it. The average magnitude of the market move, which in technical terms is absolute Sharpe ratio. The trend efficacy, or beta, that is exploited from the market move. And the diversification multiplier, which is a measure of exposure to different markets. For this year, there have been strong absolute market moves, but once discounted for volatility, they're not as good, they're not as large. The big differentiator is the trend's efficacy, or ability of the manager to exploit the trends, and market exposure differences. The most diversified managers we find have seen a drag on performance, and those managers who cut exposures given the volatility spike lost trend efficacy at just the wrong time, us being a case in point as well. We see there were four major trends to exploit in 2020, but each needed different signal capturing. Bonds needed long-term trend exploiting. Equity needed intermediate trend tracking to get short at the end of February and then turn long towards the end of March. Energy futures needed an intermediate model that could hold a trend in the face of volatility. And finally, and not least, the currency trading needed a shorter time frame. No one trend approach could have been effective in all markets. Additionally, the concept of volatility size positioning worked against managers. As in the recent past, we find the best potential financial trends were arrested through active government intervention. When governments subvert market divergences, trend following will not reach its potential. Cutting market tails may be in the public's interest, but it will distort the level of price dispersion. The large market moves of yesterday will not be seen in the central bank muted world of today. Now, that being said, we have three high conviction ideas, basically. The portfolio is slightly long US equities because we do believe in the resiliency of technology, as Hareen had mentioned. We are still slightly long equities. We believe that the dollar will stay buoyant for the short term at least, because it is the reserve currency. And when the economies do open up, as Hareen had alluded to, the velocity of money may pick up. That might put a bit on the dollar as well. Another conviction idea we're very strongly positioned for is short sterling. We think the fiscal deficit, trade deficit numbers in the UK are going to be very bad. We think the negative yielding gilts are also not going to help the position of sterling. And, we think there's going to be a hard Brexit. And I think those are the three ideas we have. We're slightly long US equities, we are short sterling, and we're short euro as well. And I guess that's all I have.